Hello friends, a very warm welcome to my channel. In this video, we are going to discuss a very important and a very interesting concept of value traps. Since the market has given a very big rally in the last couple of years, now most of the stocks which we look at are looking overvalued. So we are constantly looking for opportunities in the stock market where we can find stocks which are reasonably valued or undervalued. And in this process, we may end up falling in certain value traps. So to understand the concept of value traps as well as prevent ourselves in getting stuck in such value traps, I am creating this video. So if you're new to the channel, please do subscribe and hit the bell icon, and you can join our Telegram channel as well. Let's get started. So low price does not always mean that there is value in the stock. When we discuss the concept of value investing, it means that we are trying to understand what is the intrinsic value of a particular stock, which can be determined through various ways like discounted cash flow method or any other method. So when we derive at the intrinsic value and we feel that the intrinsic value is much higher than the price at which the stock is available, we feel that there is value in investing in that particular stock. So whenever you find some stock which has fallen, let's say 20, 30, 40% from its 52-week high, and it is trading at a low price, it doesn't always mean that there is value in the company. So you have to be very careful that you don't end up buying any low price stock which has fallen drastically from its highs. Or you should remove this thought from your mind that the stocks which are trading at low ticket sizes like less than 10 rupees or less than 50 rupees, such low price stocks have value in them. So we have to remove this misconception from our minds that low price is not always equivalent to a value in the particular stock. Now, what is the meaning of a value trap? Value trap is certain opportunities or stocks which are trading at very low prices, which appear to be value buying opportunities, but they are trading at such low levels because of various reasons which the shareholder or the investor may or may not understand. So as he is not able to judge or understand the reason why the stock is trading at such low valuations, he ends up buying them in a hope that the stock will get re-rated, which doesn't happen as the stock continues to remain an underperformer or the company underperforms the expectations of the shareholders and the share price never rises. So the shareholders end up getting stuck in such stocks for a long period of time. They don't make any returns or they end up making losses, exiting the stock by booking some loss at the end. So such stocks or such situations where investors get stuck are called value traps. Now, there's a myth in our minds that we should buy low PE stocks and we should exit the high PE stocks from our portfolio. But this may not hold good most of the times because a particular stock or a company has been given high PE by the markets for a particular reason. At the same time, the stock is given low PE by the markets for a particular reason. So when you end up shifting your money from a high PE to a low PE stock, you may end up shifting your money from a company which is performing good to a company which is underperforming as per the expectations of the shareholders, which results in your portfolio returns going down and your attempt of generating value by shifting to a low PE stock gets failed. To understand this concept, let us discuss a particular example. Let's talk about the pipes industry. In the pipes industry, there's a company called Finolex Industries which generally trades at a low PE of around 30. In the last 5 years, if you see, the stock has given a return of 137%. If you see standalone basis, the stock has given decent returns for its shareholders. But when you compare this with another company which is a market leader in the same sector, which is Astral Poly, Astral has given around 825% returns in the last 5 years. And Astral trades at a very high PE of 82. So in such situations, if you as a shareholder or an investor try to shift your money from a market leader or a company like Astral where there is a lot of competitive edge, there's a lot of brand value, there's a lot of diversification into new products, there's a lot of capacity expansion. By just looking at high valuations, if you shift your money from a high P stock to a low valued stock like Finolex, your portfolio returns may get hampered or your portfolio will start underperforming. We are not commenting on the companies that Finolex is a bad company, but we are just discussing with an example that shifting your money from a high P stock to a low P stock may not always be a correct decision. In fact, most of the times, if you are not very confident, it will end up resulting in a wrong decision for a portfolio point of view. The traditional concept of pure value investing may not hold good during these times. Because if there is no growth in the company and if you feel that the stock is undervalued and you end up buying such companies by identifying some value in the stocks, still the stocks may underperform. So pure value investing may not work. In today's world, it is always better to invest in growth-oriented companies and try to identify value in such companies, and that would be the right decision for your investments. Now, there's another concept called growth traps. It's not only that the companies which are not growing rapidly can become a value trap and cause loss to your portfolio. Even if you are investing in high growth companies, you may end up in a growth trap. Now, what is a growth trap? If there's a company which is being given very high valuation, that means the shareholders, both the institutional shareholders as well as the retail shareholders or the entire market is expecting the company to do very well in terms of growth in revenue, well in terms of margins expansion, well in terms of acquiring more companies, adding more products to the portfolio. So these are certain expectations of the shareholders towards that company, and that's the reason why the market gives such companies very high valuation. Now, when such companies start underperforming, when the market or when the management gives some guidance and they are not achieving those guidance, the management also starts reducing the estimates which they generally give in their con calls and everywhere. So in such situations, what happens is, since the company is not performing up to the mark, the market devalues such company or the re-rating happens towards the downside. Now since you bought the stock at a high valuation, you get stuck in a growth trap. So like value trap, there is also a possibility when you buy high growth companies that you get stuck in a growth trap. So you have to closely monitor the companies which you are invested in on a quarterly basis and see whether the purpose of your investment is met and it holds good continuously. What are the signs that whether the stock which you have purchased or the company which you have invested in is a value trap? Underperformance could be one of the reasons where there's no growth in the top line of the company, the margins are not expanding. In fact, the margins may be shrinking due to competition. There might be corporate governance issues or the management issues in the past. The company may not have strong competitive advantage or economic moat, and their competitors may be eating away the market share of this company also. The management might be giving unrealistic guidances and they may not be able to achieve it every quarter. The company's owners or the management are not able to allocate capital in proper areas, and the additional capital whichever they deploy might be generating lower return on capital or lower margins for the company. Sometimes the cyclical industries like metals and other commodities appear to be low valued companies during their down cycle, and with the hope that they will immediately bounce back, you get trapped in such stocks. And there could also be a possibility where a particular industry is facing some headwinds or some economic problems, which that industry ends up into a downturn for a long period of time. So in such scenarios, whenever you see such signs in a particular sector or in a company, you should check whether you are actually fallen into a value trap, and you should try to get out of it as soon as possible and shift your money to a better company and a better sector to recover your losses. How should you save yourself from being stuck in such value traps? So whenever you make an investment, the first thing I would suggest is you should invest in growth oriented companies where there is at least 10 to 15% growth every year in the top line. The company should have economic moat or competitive advantage when compared to its competitors. The other companies should not be able to replace the company's business easily, or there shouldn't be easy competition sprouting in the market. Keep in mind that whatever sector your company belongs to, that company should be either matching the industry performance or preferably exceeding industry performance. You should have a clear cut check on the management background before investing in the company. There should not be any issues of the management in the past. And whenever you find value in a company, you should ask yourself this question, that even if I am buying a low valuation stock, why is there a chance for a re-rating? Why would this company be re-rated? What is new happening in this company which will make the various investors give this company a higher valuation? So when you do all these checks and you're very clear of the reason why your particular company or the stock will get re-rated, then only you should go ahead and invest in the company. When you do these checks, it is rest assured that it's a very less possibility that you get stuck up in a value trap. So this is about the concept of value trap. I hope I have tried to make it clear with a simple example which I have shared. I hope this helps you in your investing journey and you try to maximize your portfolio returns by understanding such concepts and staying away from underperforming companies. So thank you for watching this video and have a wonderful day. Don't forget to subscribe the channel and hit the bell icon for notifications of all the new videos which I upload.